What's up, YouTube? Good morning. What is up, everybody? Welcome to Trey's Trades, where we have technical analysis on different stocks in the stock market, as well as potential buy, hold, or sell opinions on these given stocks. I'd like to preface by saying that I'm not a financial advisor, nor expert, so I'll take it with a grain of salt. Let's get into the video. So today, my friends, my family, my fellow Gorilla Gang, I must ask you a question. No, I'm playing. I want to talk about the June 18th calls, and more specifically, I want to talk about how these are important and how the short interest is important compared to the overall synthetics. You can think of synthetics essentially as failure to delivers and naked shorting, the consequence of both of those actions, which is essentially stock that should not exist, that circulates in the overall market. Now, a hypothetical situation right here, right, is these $40 strikes, and I want to show you something real quick. All right, so what we got cooking up right here. Check this out. On the $40 strikes that we have currently sitting for June 18th, there's open interest on 133,000 call options. Now, this is a really big number, and to be honest with you, I can't guarantee anybody that is going to hit in the money immediately, on that day or what's going to happen. But I want to provide you with a hypothetical, right? $40 strikes. There's open interest on 133,000 total call options, and there's 100 shares per contract. If these were to run in the money, the market makers who wrote up these contracts would be responsible for about 13.3 million total shares worth of hedging. Now, this would take place if, let's say, hypothetically speaking, the market value was sitting at $41, $42. It was over that break-even price, right? They're going to start hedging for that stock, essentially just anticipating that there are going to be people that end up exercising those $40 strike call options, and they need to have the shares readily available for if people decide that they want to do that. But here's the problem, right? Knowing what we know about the overall float, the overall shares outstanding, right? Apes own 80% of the total shares outstanding equaling about 450 million shares. So we're just going to call this a round number of about 360 million. Might be out by a little bit, just estimating that, right? We know currently that according to the Ortex data, you've got about 128 million shares on loan, right? 128 million right here. We know that institutions own about 100 million total shares. We know that insiders own at least 10 million shares, right? Do all this math, add it up, you get more shares overall than should exist in the overall free float, which is about 450 million. We already know this, right? We've been talking about this math for a very long time. But I wanted to give you a hypothesis on what would happen if these $40 strikes were to run in the money, because it is very fascinating. This could be a huge catalyst that would drive further price action for more than one reason, right? So this 133,000 total call contracts, sure, you'd have 13.3 million shares that would have to get bought at market value, but what if they can't buy them, right? Well, this brings us to this. Failure to delivers, right? Failure to delivers are a huge cause of the synthetic shares that are circulating all over the marketplace. And there's a big consequence for this, right? In the short term, it creates a little bit of selling pressure, right? But when they get cracked down on, the consequence is actually good. It's a good thing, because this is ultimately shares that have to be bought back by the overall market makers that wrote these contracts if they're not able to hold up on their end of the deal, right? If they cannot come up with the stock and they create stock and they get busted, they get slapped super freaking hard by the SEC. SEC steps in and says, hey, look, we recognize that there are way more shares circulating on the market than are supposed to exist. The total shares outstanding is 450 million. Total free float is 417 million. You need to destroy the extras. They just cannot exist, right? And this brings us into kind of the short interest versus synthetics cause. But before we get into that, I just want to tell you how much of a consequence this would have for them and how much this would really help us out, because this sort of hedging, even if it just causes synthetics, those failure to delivers, there's two different options, right? Either A, you get failure to delivers, which are synthetic shares, and they have to eventually cover these failure to delivers. Or B, they do end up hedging them because they can somehow scrounge up 13.3 million shares, and this causes the mother of all freaking gamma squeezes, which will inversely cause the mother of all short squeezes. Square. This is a good thing. So second case scenario, right? If they can't deliver on this, like I'd mentioned, well, I already talked about it, never mind. I have a little space this morning. My apologies. But I want to bring this into the short interest versus synthetics. And this is exactly what I'm talking about, right? These call options that expire in the money, the failure to delivers, and the naked shorts contribute a lot to the actual synthetics versus what we see in terms of short interest, right? So let's just look at the short interest. 15.34%, which comes out to about 77 million shares, right? That's what we tangibly know. That's what can be factually proven. Is there's about 77 million total shares of short interest that have been reported. Keyword being reported, because there's a lot of malpractice, corruption, and fraudulence that takes place with these hedge funds, which we know just based on the FINRA reports and the historical trends of how these guys report short interest data. But what about these synthetics, right? Do these get reported as short interest? Well, the simple answer to me is no, right? Think about all of the failure to delivers that have come out of call options that have run in the money and then didn't end up getting hedged for. I know you guys have seen the numbers. It's stupid. There's been millions and millions and millions of shares in the last last 6 months that have been failed to deliver since the beginning of this whole situation back in January, right? So what would happen if these 13.3 million shares did not get delivered? They turn out to be FTDs, right? These are synthetics. And you can think about the short interest as what we can tangibly prove, right? Outside of naked shorts, we don't know that. But what about the synthetic shares, right? How much do we know about this? Because this does not equal the total short interest, right? Short interest is not 77 million. You can think of the short interest being the equation of short interest that is reported, right? This is an important factor. Short interest that's reported plus naked short interest plus FTDs. And I know that FTDs aren't technically short interest, but they do cause synthetic selling pressure. So this overall does contribute to what is holding down AMC stock. I would not be surprised in the least bit if this was a fair freaking game. This stock right now would be in 40, 45, 50, 55, $60 range, just based on the numbers and how many people have been buying AMC stock overall, seeing that most people are, that buy it, hold it, 90 to 95% just based on the things that I've seen online, 5 to 10% end up selling, right? That's a huge, huge number. So the real short interest, the real amount of selling pressure and what we're up against is not just what's reported to the exchanges, right? It's more than that. It's numbers like this. It's numbers like that 13.3 million shares that could end up expiring in the money and cause failure to delivers. Failure to delivers to me equals synthetics, and they also equal need to be covered. They need to be bought back, right? You can't have synthetic stocks circulating on the market for a prolonged or indefinite period of time. Eventually, there will come a day when this needs to get cracked down on. Now, what if, right? I got to connect the dots here somehow, right? What happens if these do end up expiring in the money? Now, obviously, the odds, we can't guarantee anything just because we don't know the timeline of the squeeze. And I'm not trying to time, the timeline of the squeeze. What I am saying is if this does happen, this could be the mother of all catalysts that could drive the beginning of the end of this short squeeze, right? Because 13.3 million shares, if they fail to deliver on that, that is going to raise some major red flags to the SEC. And if they do deliver on these somehow, the gamma squeeze on this is going to be stupid, disgusting, filthy. It's going to bring you the best tasting lemon pepper tendies that Drake could ever freaking write a song about, which is going to cause this short squeeze. 150%, right? So I kind of want to cover two things here with this short morning video. I want to talk about these $40 strikes. What would actually happen if these were to run in the money? It would be night and day. This would be lights out. You would see the stupidest price action you've ever seen on AMC stock, because either A, these are going to get hedged for, and that's going to come straight from market value, which means it's going to drive the price up, or B, they'll fail to deliver, and fail to deliver equals synthetic stock, right? And with that much price action, if these were run in the money at $40 and all of a sudden they freaking wipe the slate clean, red flag, red flag, red flag, red flag, red flag, red flag, red flag. That's that freaking simple, right? There's no situation to me where these $40 strikes run in the money and they either deliver or they don't deliver, or we don't win. It's as simple as that. So I want to go over that. I want to go over the overall short interest and how we don't see the whole equation, right? Short interest is not just equal to short interest. Reported short interest, it's also equal to naked short interest and failure to delivers, because both of these things you can consider, dragging price down. They do both cause selling pressure. That's what I've got for this short morning video. If you watched through the whole thing, appreciate you immensely. I just want to run you through kind of what my schedule is going to be like for the indefinite future until I can move out to North Carolina full time. But for now, what I'm planning on doing is a morning video, right? I'm going to try and live stream at least a couple days a week during my lunch break, which is typically between 11:30 a.m. and 1 p.m. Central Standard Time, as well as an evening video. So I didn't get you guys as much information as I possibly can, give you any DD research that I've done, and the whole 9 yards. So blah, blah, blah. I know the whole spiel. Drop a like, consider subscribing, whatever you want to freaking do. That is what I've got for you guys this morning. Much love. Catch you later, and peace.